You know that feeling when you check your bank account and instead of closing the app in horror, you actually smile? Like when you stop calculating whether you can afford that coffee or if buying groceries means eating ramen for the rest of the week. There is a specific liquid capital threshold where this psychological shift happens, and it is not what most people think. Financial gurus will tell you that you need $1 million to feel wealthy, or that 6 figures is the magic number. But here is the critical key they are missing. There is a much smaller milestone that completely transforms your relationship with money. Once you hit this exact baseline threshold, everything about your financial life changes permanently. That magic capital milestone is $20,000. Welcome back to the FinRadius USA, where we decode financial psychology and the real mechanics of wealth building. If you want to understand why some build wealth effortlessly while others stay stuck for decades, hit subscribe and like this video. Now, before we dive into why $20,000 is the ultimate game changer, ask yourself, what comes to mind when you picture building wealth? Maybe you picture a trust fund heir who never worried about cash, or someone grinding away accumulating $1 at a time. The truth is, wealth building does not work in the linear way most people assume. There are specific financial thresholds that act like invisible structural barriers in your life. Once you cross them, the underlying rules of the financial game completely change in your favor. $20,000 is the first major threshold separating those who build wealth from those trapped in the paycheck to paycheck cycle. And the crazy part is that most individuals have no idea this primary threshold even exists. Think about it this way. If you have ever tried to push a heavy granite boulder up a steep hill, you know that getting it started from zero velocity is the absolute hardest part of the journey. You are straining, sweating, making almost no visible progress, and questioning if it is even possible. But once you build enough momentum and reach the top, something magical happens to the boulder. The boulder starts moving faster, and eventually rolls down the opposite side almost effortlessly. $20,000 is that exact turning point where your financial boulder finally crests the hill. Everything before this point feels like you are pushing uphill against relentless economic gravity. Everything after this point feels like financial gravity is finally working directly in your favor. But here's where it gets really interesting, and this will probably surprise you. The core difference at $20,000 isn't just mathematical. It is deeply psychological. It is not simply that you have more capital to invest or that your returns are larger in absolute terms. The real transformation occurs directly inside your brain's neurological processing system. When you have zero money saved, your brain operates in what psychologists call survival mode. Every single financial decision in your daily life is filtered through baseline fear and scarcity. You take the first terrible job offer that comes along because you cannot afford to be picky. You stay in toxic employment situations you hate because leaving feels like immediate financial suicide. You say yes to unreasonable workplace demands because you desperately need next week's paycheck. This isn't just about being practical or responsible with your personal finances. When in survival mode, your brain literally lacks the cognitive bandwidth to think about growth. It is like trying to plan a luxury summer vacation while your house is actively on fire. Your mental energy is completely consumed by immediate short-term survival threats. But something remarkable happens when you finally cross that $20,000 milestone. Suddenly, your brain unlocks the neurological space required to evaluate life differently. Instead of asking, how do I survive until next paycheck? You start asking, how can I grow this capital? Instead of reacting helplessly to financial crises, you become proactive about building asset equity. Research from Vanguard proves that having just $2,000 in emergency savings increases well-being by 21%. $2,000, less than most spend on a fancy laptop, creates a massive psychological shift. That small cash buffer moves your cognitive state completely out of pure survival panic. When you push that emergency fund to 3 to 6 months of expenses, around $20,000, you get another 13% boost in measured financial well-being and stability. More importantly, you create enough breathing room to focus on wealth building instead of mere preservation. Now here is where the raw mathematical compounding starts getting really exciting. Let's say you are saving $1,000 every month while earning an 8% return on investments. Reaching your first $20,000 takes roughly 19 months of consistent saving and investing. That is a year and a half of discipline, sacrifice, budget tracking, and delayed gratification. It is not easy. And frankly, most people surrender somewhere along the execution timeline. But here's the part that will blow your mind. Your second $20,000 does not take 19 months. It only takes about 17 months. Why? Because now your first $20,000 is working alongside your monthly contributions. Think about this. You did the exact same work and saved the exact same monthly amount. Yet you shaved 2 full months off the timeline simply because your money was working for you. That is the power of compound interest starting to take over the heavy lifting. By the time you are aiming for your third $20,000, the required timeline shrinks even further. Your existing capital does an increasing share of the work while your physical labor stays constant. And when you reach larger portfolio milestones, the compounding acceleration becomes almost comical. Once you hit $400,000 in your portfolio, it generates your next $20,000 in just 5 months automatically. The exact same amount that initially took 2 years to save is now happening automatically through market yields. That first milestone feels nearly impossible, but every milestone after that becomes progressively easier. Now, you might assume wealthy people have access to secret investment worlds regular folks cannot touch, like exclusive hedge funds or special opportunities that only unlock at extreme wealth tiers. While some truth exists at the ultra-high end, that is not what drives the $20,000 turning point. The real secret is much simpler and far more encouraging. Basic mathematics working in your favor. When you invest $1,000 and it grows 10% in a year, you make $100. Apply that exact same 10% growth rate to $10,000, and suddenly you gain $1,000. Same time frame, same risk, same percentage. And at $20,000, that 10% return is $2,000. Up until $20,000, investment returns feel insignificant because you are working with small amounts. A 10% return on $2,000 is $200. Nice, but hardly life-changing. But a 10% return on $20,000 is $2,000. Now we are talking real capital. With $20,000 earning 8% annually, $1,600 flows into your account passively. Money you did not have to exchange your finite life hours for at a daily job. Money that materialized simply because your existing capital was working on your behalf. The investment strategy isn't any more sophisticated than what someone with $1,000 uses. You buy the exact same index funds, use the same brokerages, and follow identical principles. The only difference is scale. And scale transforms minor percentage wins into massive financial progress. But here's the part most people miss, and it might be the most important point in this video. When you save $20,000, you accomplish something far greater than accumulating bank digits. You fundamentally rewire your cognitive identity and build the most critical financial habit of your life. Think about what it actually takes to save $20,000 if starting from zero. Unless you make absurd money or live rent-free, this requires serious, sustained discipline. You had to track every dollar, say no to short-term desires, and resist impulse purchases. Most importantly, you had to execute this discipline consistently for months or years. You proved to yourself that you control your money instead of letting money control you. You became the type of individual who can execute long-term delayed gratification when it matters. That is not just a financial skill. That is an essential life skill. This identity shift is massive because it impacts every future financial choice you make. Before $20,000, buying a $4 coffee might trigger anxiety about affordability. After $20,000, you stop sweating micro expenses because your priorities are locked in. You have proven to your subconscious that you can make big strategic sacrifices when necessary. There is another psychological shift at this level. You start seeing opportunities instead of threats. When living paycheck to paycheck, every unexpected expense feels like an absolute disaster. Car repairs, a dead laptop, or a rent increase are emergencies that derail your entire month. But with $20,000 in the bank, those exact events become minor inconveniences. Car repairs are annoying, but not catastrophic. A dead laptop is an excuse to upgrade your tools. A rent increase simply prompts you to evaluate better housing or negotiate your income. Even better, you start noticing high-leverage opportunities that were previously invisible. A friend mentioned starting a business and seeking early seed investors. Previously, you would scroll past. Now, you can analyze allocating $5,000 into equity. A distressed rental property appears on the market below replacement cost. Now you can run the underwriting numbers and acquire real estate equity. Your boss mentions an industry conference that could accelerate your career trajectory. Instead of making excuses about cost, you weigh the potential return on investment. This is what wealth allocators mean when they state that money goes to money. It is not a cosmic conspiracy. Having money provides options, and options create wealth. Crossing $20,000 also makes you question everything about traditional budgeting. You start caring less about tiny micro expenses and more about massive macro decisions. When broke, you obsess over every purchase: generic cereal, $3 coffees, or regular gas. These micro decisions consume mental energy because every single dollar feels precious. But with a solid financial foundation, you realize these micro choices are largely irrelevant. The difference between buying coffee out versus making it at home is maybe $1,000 a year. That is not nothing, but it will never build long-term generational wealth on its own. What actually matters are the big decisions: housing, vehicles, savings rates, and asset allocation. These macro choices swing your total net worth by tens or hundreds of thousands over time. So instead of agonizing over organic bananas, you focus on optimizing housing and income. This shift in focus frees up mental bandwidth for the strategic decisions that actually build wealth. Now let's analyze what happens to your career dynamics once you hit this milestone. Having $20,000 saved changes your relationship with work entirely. When living paycheck to paycheck, you are essentially trapped in whatever job you occupy. Toxic management, mind-numbing tasks. You cannot leave because you need next week's check. This puts you in an extremely weak negotiating posture with your employer. You hesitate to ask for a raise because you fear the potential risk of employer pushback. You accept unreasonable workloads because your employer understands you cannot afford to resign. You avoid exploring new opportunities because taking time off for interviews feels too dangerous. But $20,000 changes the dynamic. You possess walking away power. You could resign tomorrow and survive for months while securing a far better position. You negotiate from a position of genuine strength rather than survival desperation. You ask for the raise you deserve because the worst they can say is no, and you will be fine either way. You push back on unreasonable demands because you do not fear immediate termination. You explore new career paths because you have the liquid runway to absorb temporary risk. Often, you don't even need to use your walking away money. Simply having it changes your demeanor. You become more confident, more assertive, and more willing to tackle challenging projects. When you show up with confidence, leadership notices and rewards your executive posture. Suddenly, you receive better assignments, stronger recognition, and higher compensation. It is like possessing a secret superpower that elevates your entire career performance. The more successful you become at work, the faster you build capital, creating a positive feedback loop. But here's where most people mess this up. They hit $20,000 and blow it on lifestyle inflation. They feel the psychological shift and immediately spend their milestone on a new car or lavish vacation. Or they use it as a down payment on a residential home that drains their liquid margin completely. Don't do this! That $20,000 is the foundational bedrock of your entire financial future. It is the primary seed that grows into generational wealth if you let it compound patiently. Consider this sobering reality. The average person spends more on vehicles over a lifetime than required for retirement wealth. Between car payments, insurance, fuel, and maintenance, most drop $600 to $800 monthly. Over a 40-year career, that recurring leakage exceeds $400,000 in lost capital. Meanwhile, individuals claim they cannot afford to save for retirement while operating depreciating assets. The moment you drive a new car off the lot, it loses roughly 20% of its market value. You are not merely spending money. You are actively destroying investable wealth. Compare that destruction to deploying the exact same monthly allocation into a broad market index framework. Instead of watching your money evaporate into depreciation, you watch it multiply over time. Vehicles are emotional purchases. You want reliability, safety, and a sense of success. There is nothing wrong with quality, provided you understand what you are surrendering in long-term freedom. That $30,000 vehicle is not just $30,000. It is $200,000 in lost compounding over 20 years. Driving a reliable used vehicle stops feeling like a sacrifice and becomes a tactical choice funding your sovereignty. Here's the beautiful irony. The driver in the flashy new car is often stressed about monthly debt payments, while the owner of the older sedan is quietly compounding wealth and sleeping peacefully every night. This mindset shift extends to every major financial choice across your entire lifestyle. Housing, education, travel, and hobbies are all filtered strictly through the lens of opportunity cost, not in an obsessive way that drains joy, but in a strategic way that ensures intentionality with your capital. Once you think this way, you realize you do not even desire half the status items you used to crave. That larger apartment? The extra space is nice, but is it worth delaying your independence by 5 years? That expensive hobby? It is fun, but cheaper alternatives deliver identical satisfaction without draining equity. This is not about becoming a miserly penny pincher. It is about becoming intentional with your money. When you have clear targets and understand compounding, distinguishing wants from real desires becomes effortless. $20,000 won't make you rich overnight, but it will fundamentally change how you think about life. It is the fundamental difference between surviving and thriving, between reacting to life and designing it. Start building that foundation today, because your future self is counting on the decisions you execute right now. Trust me, when your capital engine takes over your baseline expenses, your future self will thank you for it. Now let's review the step-by-step execution checklist recommended by the research team at the FinRadius USA. Checkpoint 1. Build your initial $2,000 liquid emergency cushion immediately. This small initial buffer breaks acute neurological survival mode and stops immediate debt escalation. Checkpoint 2. Systematically push your liquid savings reserve to $20,000. This crests your financial momentum over the hill, unlocking the power of compounding yield. Checkpoint 3. Deploy all surplus capital above your cushion into the 4 core hard asset pillars. Allocate systematically across monetary gold, digital scarcity, broad market index equities, and essential commodities. Checkpoint 4. Leverage your walking away power to command higher professional income. Negotiate aggressively or transition to higher yielding roles without fearing temporary gaps between checks. Checkpoint 5. Filter every major lifestyle expenditure through strict long-term opportunity cost analysis. Stop donating your investable margin to depreciating assets that keep you bound to corporate labor. Checkpoint 6. Automate your asset allocation system to eliminate decision fatigue permanently. Route 50% of your monthly capital surplus directly into assets within 24 hours of deposit. Checkpoint 7. Maintain physical non-custodial security over a portion of your emergency reserves. Store physical bullion or hardware keys off-grid to protect execution capability during systemic halts. Checkpoint 8. Audit all personal debt liabilities and eliminate high-interest variable friction immediately. High-interest debt compounds against your net worth faster than inflation erodes savings. Wipe it out cleanly. Reclaim your cash flow margin and redirect every available dollar directly into your wealth engine. Checkpoint 9. Reframe your primary corporate job strictly as a venture funding mechanism for your asset firm. View your employer as a temporary capital source while you build assets that you own 100%. Checkpoint 10. Dedicate 2 hours every morning to constructing an asymmetric parallel asset runway. Build digital leverage, skills, or cash-flowing media assets before trading hours at your day job. When your side asset cash flow equals 50% of your job salary, your systemic freedom is locked. You step outside the corporate dependency machine permanently and claim absolute financial sovereignty. Your future self is counting on the capital allocation decisions you execute starting tonight. Do not allow another year of passive paycheck consumption to erode your potential runway. Take audit of your liquid reserves, enforce fixed lifestyle boundaries, and deploy capital into hard assets. Reclaim your labor output, build your asset shield, and step onto the path of true wealth creation. The mathematics of compound growth are completely objective. They reward those who take disciplined action. Math deletes institutional illusions and breaks the psychological hold of the paycheck cycle. If this quantitative analysis brought you actionable clarity, share this breakdown with someone who needs it. Drop a comment below with your current liquid target. We read and analyze every single response. Subscribe to the FinRadius USA to join our community of sovereign allocators taking back control. Together, we decode system mechanics and construct unyielding personal balance sheets. Stay disciplined, stay insulated, and trust the mathematics of compound capital growth. Remember, $20,000 is not just money. It is the exact point where freedom becomes mathematical. Keep your fixed costs locked, automate your asset accumulation, and protect your runway at all costs. Every single dollar you save today accelerates the moment your capital takes over your physical labor. The corporate system relies on consumer debt to keep workers compliant and dependent on monthly checks. Break those chains by refusing to finance depreciating status symbols that keep you locked to a desk. Choose long-term sovereign freedom over short-term visual prestige every single time. The path to true wealth is quiet, intentional, and driven entirely by objective compounding mathematics. When you own hard assets, central bank debasement works in your favor through nominal asset appreciation. You convert central bank monetary expansion into automatic net worth creation for your family. Meanwhile, passive cash holders continue absorbing the silent decay of the hidden inflation tax. Step outside that extraction framework permanently by building your $20,000 foundation tonight. Your future self will look back on this exact decision as the catalyst that changed everything. Take control of your labor, command your capital, and build your personal capital shield. We are building a global community of sovereign allocators who understand systemic math. Subscribe now, turn on notifications, and share this video with fellow allocators. Check out our archive breakdowns linked on screen to master macrofinance and behavioral psychology. Every breakdown delivers quantitative, actionable frameworks to protect and compound your net worth. Never forget, math deletes institutional dependency, and discipline creates permanent sovereignty. Execute your plan, protect your liquid runway, and stay insulated against economic shocks. The journey to complete financial independence starts with that single $20,000 baseline. Cross that crest, let compound interest take over, and claim absolute control over your life. This is the FinRadius USA, your premier resource for capital preservation and sovereign strategy. We will continue decoding macro system mechanics so you can build unyielding family wealth. Audit your bank account tonight, calculate your target milestone, and begin execution immediately. Thank you for your time, your focus, and your commitment to financial sovereignty. Stay disciplined, stay insulated, and trust the mathematics of compound growth. We will see you in our next deep dive decoding breakdown.